Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're covering what it means to be doing business in California for the purposes of filing returns and paying the annual or minimum franchise tax. Take a deep dive into California state tax issues like conformity, the pass-through entity tax, residency issues, and more at Spiedel's Critical California Tax Issues webinar. The live session is happening on August 28th, and you can get details and register at caltax.com. California has two different doing business tests for the purposes of determining whether a taxpayer has nexus with the state and therefore is required to file a return and pay the $800 annual or minimum franchise tax. A taxpayer is considered to be doing business if it meets one of the following tests. The taxpayer actively engages in any transaction for the purpose of financial or pecuniary gain or profit, or the taxpayer meets the factor threshold economic nexus test by being organized or commercially domiciled in California, having California sales exceeding $711,538 for 2023, or 25% of the entity's total sales, having California real or tangible personal property valued at original cost exceeding $71,154, or 25% of the entity's total real property and tangible personal property, or having California compensation exceeding $71,154, or 25% of the total compensation paid by the entity. The 2024 Economic Nexus threshold dollar amounts will be released in the fall in the FTB's annual indexing memorandum. Many taxpayers and tax professionals mistakenly believe that if their sales, property, or payroll are below the thresholds we just outlined, that they're not considered to be doing business in California. In a recent Office of Tax Appeals decision, a Minnesota LLC was required to file a California income tax return and pay the $800 annual tax for the tax year that it owned inventory at Amazon fulfillment centers in California. This was because it met the definition of a retailer engaged in business in California because it was engaging in a transaction for purposes of financial or pecuniary gain or profit, even though the amount of its property located in California was below the threshold amounts. Earlier court and administrative decisions have also found that an entity was doing business in California when its corporate secretary was in California performing tasks on behalf of the corporation, or when an entity's president and sole shareholder was located in California, even though its business operations were located in Nevada. In another recent Office of Tax Appeals decision, a Maryland S corporation was liable for over $14,000 in per-shareholder penalties for failing to timely file its 2018 and 2019 tax returns. The penalties applied even though the S corporation had no business activities in California during those tax years and was not even liable for the $800 minimum franchise tax during 2018 because of the first-year minimum tax exemption. Unbeknownst to the taxpayer, once it filed registration papers with the Secretary of State's office, it became qualified to transact business in California. This meant that the taxpayer was subject to California's minimum franchise tax and was required to file a California S corporation tax return. The decision is a harsh reminder that ignorance of California's tax filing requirements is no excuse, and that the per-shareholder penalties of $18 per shareholder per month imposed for up to 12 months can quickly add up. This was demonstrated by the over $14,000 in per-shareholder penalties imposed against the taxpayer in this case. Stay up to date with California tax law changes with a subscription to Spiedel's California Tax Letter. You can see the benefits of subscribing and download a sample issue at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.